Okay, hello everybody. Welcome to Korean Atlanta Mentorship, the financially freest cult ever. So here we have another TikTok video about how much credit card debt I have spread across 7 cards. Spoiler, it's bad, bad. And by the way, as a side note, you ever notice that it's just all ladies who make these videos? Like every single one. Like I don't think I've seen a video with a dude talking about their credit card debt. I don't know if it's because they're shy or if they're better with money, but it's just all ladies. And I'm just like, ladies, what, come on. All right, so let's go ahead and watch and see what's up.
Let's talk about how much credit card debt I am in, and spoiler alert, it is massive. So, let me preface all of this by saying that I have an actual real life spending addiction. Spending money makes me feel so good. It makes me so happy. If I am sad, I spend money. If I'm happy, I spend money. If I'm feeling blah, I spend money. It does not matter what my emotion is, I'm going to spend money. And my money spending is tied to all of these emotions. I was recently diagnosed with bipolar disorder, so I have been undiagnosed for years and years and years. And I realized that all of these ups and downs that I've been feeling have been manic and depression episodes. And now that I have those answers, I am ready to dive in, do the work, and get this crap paid off. So without further ado, let's get started. I have a total of 7 credit cards with balances on them, and when I tell you these balances, your jaw is going to hit the floor. I'm just going to prepare you right now. So let's dive in. My lowest card is my Discover card. It has a total of $4,904. My next card is a USAA card that is currently sitting with a 0% APR because it is a balance transfer card, and that has a balance of $5,642. After that, I have another one that has a balance of $7,201. My husband has one that has $7,807 on it. Then we are moving up to the big guns, and our first big gun is sitting at $11,500. After that, we have a Cash Rewards Visa, and that is $18,775. And after that, we have my American Express, which is sitting at $25,000. When you add all of that together, we get $80,829.
I thought the way that she made it seem, I thought she was gonna be like, I have like $500,000 of credit card debt. I was like, whoa.
And credit card debt. So, if you are interested in watching the journey of me paying this off, making my life better, creating my dream life, all of the things, now that I have been properly diagnosed and I have started medication and therapy, then make sure you hit that follow button because I will be sharing updates along the way.
Okay,
Let's
so
talk
how
about how
much
much
was it?
credit card debt I am.
Um,
$829.
$80,829. All right, well, let's go ahead and try to pay off debt that's more than that because, it's all proportional to your income, and let's get paid off. So give me one moment to open up the Velocity Banking spreadsheet. All right, here we go. So we have someone with a lot of debt. So let's actually count the amount of debt that the person has. 5, 8, 15, whoopsie, 15, 27, 30, 7, 10, 35, 12, 15, 20, 220. And how much debt do we have in total? $404,000 of debt, right? So a lot of people would freak out over $80,000 of debt, but here we're going to pay off $404,000 of debt, which includes the credit cards, 10 credit cards, auto loan, and mortgage. So now that we've seen what people are freaked out about, what do we have here? We have someone who makes really good money. So $8,000 after tax is probably around maybe 140-ish, 140K-ish. And just because you make a lot of money doesn't mean that you're doing that well, because who is the bank's favorite target for giving debt to people? Or I don't know if I said that grammatically correct, but who do they love giving debt to? people who don't need money. So once upon a time, this person who made great income did not need money, took on a lot of debt, and then they just kept piling on debt. Now, what is this phenomenon called? It's called segregation of income. So you have your paycheck coming in, and then it gets split into up the wazoo all over the place. So here we have 12 different debts. So it gets split into 12 different places, and then you have the leftover in your checking and savings, and then the responsible thing is basically putting that checking and savings and keeping it there and saving that money in case of emergencies, right? So what we're going to do is essentially pay off that debt, okay? Same income, same expenses, and we're just going to use something called velocity banking. So what is velocity banking? It's just a very fancy term, marketing term for not saving money and then using a line of credit to manage your cash flow, right? That's all velocity banking is. So if you ever thought about whether you should save money or not, velocity banking is literally just another fancy way to not save money. And sometimes you need those fancy terms to help you achieve your goal because I'll be honest, if I had never learned this, I probably would have tried to save money if I had debt. But that's not what we're going to try and do. Okay. And so now we have this formula here called the cash flow index. So if you don't know what it is, you take the balance of your debt and then you divide it by the payment, right? And then it's going to give you a number. Okay. So what does this number mean? The lower the number, that means you get more bang for your buck for paying off the debt in terms of cash flow. So think of this as a debt ranking system about which ones you should pay off first. And so the higher the number, that's the one you want to pay off last. So if you take a look at the mortgage here, $220,000 debt. If I give the mortgage company $220,000, I only get $927 back in my cash flow, right? Whereas if I pay off this $30,000 debt, then I get $1,050 back in my cash flow. Okay. All right. So now let's go ahead and assume that we have access to something called a line of credit. So what's a line of credit? It's basically a financial tool where you can borrow money, pay it back, and then use it over and over again. So here I have access to actually, I don't have access. I am a homeowner, so I potentially have access to something called a home equity line of credit, right? And let's just say it's $200,000. So think of this as a credit card attached to your house. If you don't pay that credit card, then the bank has the right to foreclose on your house, right? But it's even better than a credit card in certain ways because you get lower interest rates because it's tied to your house. And not only that, you get access to more money, right? And you can use it to pay anything. So with the credit card, you can't use it to pay another credit card. But here you can use this to pay itself. It's crazy, even though you'll be racking up a lot of interest if you do that. But it's so flexible, you can use it to pay anything that you want, usually, right? And so what we're going to do is we're just going to do a balance transfer to this home equity line of credit. Now, would the bank ever give you a free and clear line of credit when you only have $52 left over? The answer to that is no. Why is the answer to that no? Is because banks don't lend money to people who need it, right? Banks don't lend money to people who need it. And people who need money are a risk because they won't pay you back. And the bank knows this as an institution. Think of how many transactions a bank does in a day, right? A gajillion. And they have all these data points. And from their data points, they came to the conclusion, oh my goodness, people who need money don't pay you back, right? And they want to be paid back, okay? They don't want to be paid too quickly. But what's even worse is if they don't get paid back, okay? So, um, now, why do we demonstrate free, clear line of credit? Well, it's because I always say that if you'd known the strategy from the beginning, this could have been your lifesaver and you would never even be here at $52 left over. Okay. All right. So now let's go ahead and do this. So we have about 10 credit cards. So how much is this again? 5, 8, 15, 27, 30, 7, 10, 35, 12, 15. And then I'm going to go ahead and sum it up. So how much is this in total? This is about $164,000 of debt. $164,000 of debt. Okay. So once we move that, remember the other lady there, she was like 80 something thousand dollars of debt, and she was like, "You are gonna be so, I don't want to say impressed. What was it? Was it shocked? And I'm like, yeah, whatever, been there, done that. Anyways, all right, so let's say you take a look here at these credit cards, right? So what happens here? And well, these essentially go to zero because we just did a balance transfer, right? So guess what happens? Oh my goodness, this is like the clickbaitiest clickbait moment ever. Is that this literally goes from $52 to $5,213.10. And look at this income section. We didn't make more money, right? We didn't make more money. Okay. So what we do is we put our entire paycheck into the line of credit. This is the final step because what we're going to do is make our line of credit as our quote main operating account, meaning that we dump all of our money into the line of credit. So normally when we do traditional banking, what we do is our paycheck comes into our checking account and then we pay our bills and we put the leftover in checking and savings, right? The way that we treat our checking account is rather than like the final destination of our money, it's like the intermediary, right? So we get paid, okay, and then we just in our checking account and then we just dump it all into the line of credit as an overpayment, right? And so now let's go ahead and do this. And I'm going to do G2 plus H2 minus 5213.1. So why do we do that? It's because to get the next month's balance, we take the previous month's balance, interest, and then subtract our cash flow number. Okay, we take our paycheck in, expenses out, and then what we're going to do is we take the average daily balance, right? Average daily balance. So that would be G1, right? And then G, comma G2. Wait a minute. G2. G3. Average daily balance multiplied by the interest rate, and then you divide by 12, right? And that's how you get the interest for the month. Okay, and then I'm going to go ahead and copy and paste, and then whoa-blam, look at that. After a couple months, we just paid off our debt. And then alakazam, and so now we take a look here. So we see that in 36 months, whoa, it's all paid off, right? So in 3 years, we literally paid off $164,000 of credit card debt. And that was so easy, right? So we did that in three years. We're good. 36 months, 164K. Okay. And then I'm going to go ahead and do this. And then now we have the auto loan and the mortgage. So we have these loan calculators right here where we could just literally type in what the current month is, and then it'll give us the current balance. And then now we have the cash flow index. We just follow that model. So I'm going to pay off this debt here for the auto loan. I'm going to do this. I'm going to do this. And then this is going to be plus 8361.18. And then guess what happens when we move that auto loan here? So now we get an extra $359 back in our cash flow. And then this is going to be 5,527. Okay. And then this is going to be 5572.47. All right. And then we see that we paid it off in 1 month. All right, sweet. So the car is now gone after 1 month, and we paid it all off. All right, so now it's 184K, right? 184K. And then now we're going to do the 30-year mortgage, okay? So this is going to be month 37 for a 30-year mortgage. Now, should you move this $205,000 into an 8% line of credit? The answer is no, because if you move a 3% loan and it's a very long term, meaning that your payment is very low, look at this low cash flow index, into a line of credit, you don't really get that much cash flow. That's what this high cash flow number means, or cash flow index number means, is that you literally give someone $205,000 only to get a little bit of cash flow back in your life. And because of that, if you do that, you're going to end up paying more interest, right? Now, at this point, you have two options, right? You could just dump your entire 5,000 into the mortgage, or you could just use a line of credit, right? So you can still use an 8% line of credit, pay it off, and then whoop-de-doo, right? So let me just kind of show you how that works. So I'm just going to go here, month 37. All right, so now all I got to do is type in the numbers here in this velocity banking calculator if you're going to do something called chunking, which is you just move a piece of the loan into the line of credit, okay? So let me just kind of just do this. Um, so 201, 196.5. So let's, what's the current balance? 205,384.12. All right, so now, okay. And then what's the income? It's a fantastic income of $140,000 a year, probably somewhere around there, right? And if you do this enough, and then you just kind of look up after-tax figures, you kind of get a feel of like what after-tax income is. And I think in order to make not 10 grand a month after tax, you probably have to make at least 200,000, I think. Yeah. Anyways, all right. So now let's take a look here and look at this guy's expenses. It's so cheap, 1,500 a month, and he's got all to got into an insane amount of debt. But anyways, all right. So now let's go ahead and do this, and I'm gonna do this. Whoopsie. So put 1,500 here. So this is he's gonna get rid of this thing in 2.8 years. Look at that. This is because his expenses are so low, right? $1,500 a month, even though you only make $8,000 a month in income, and somehow got this extremely cheap mortgage. I know. Anyways, but that's kind of like the game of real estate investing. So if you want to know what makes like the ultimate real estate investor is being able to buy properties cheap. I mean, that's what Dave Ramsey talked about back in like the 08, 09 crisis. Was it the 08 crisis? Yeah, he was like, yeah, I got all these properties pennies on the dollar. And so the most important thing is that if you want to win with real estate, you just don't buy at market value, right? Don't buy at market value. You have a $300,000 home, you gotta buy for 200,000. If it's a $200,000 home, you gotta buy for 100,000. If it's a $100,000 home, you gotta buy for 10, right? You gotta buy for 10. Okay, well, 2.8 years. So let's go ahead and do this. So 37 divided by 12 plus 2.8. And that's going to be 5.88 years. And then we are debt free. See how easy that was? But it's 400 something thousand dollars of debt. And I had to watch a TikTok video of someone saying that, like, I won't believe she has $80,000 of credit card debt. Oh, OMG. And now I think she's taking like anti something, some psychiatric medication. No shade to you if you take psychiatric medication, but I don't think, you know. Oh yeah, I think she said she was bipolar. Anyways, again, anytime I see that kind of, people talk so nonchalantly about these things that used to be so taboo like 20 years ago. You know what I mean? But anyways, and it's funny is because maybe I'm doing that too. When if 20 years ago I said, "Hey man, just join my cult," I think that would have been like a 90s TV show episode where like one of the teens are trying to like in those family sitcoms, like one of the teens are trying to like get the other teen out of the cult. It's like and then they at the end of the episode they always do like a now you know. You know what I mean? Like don't do drugs, don't use weapons, don't join cults. And I'm like, yeah, join my cult, join my cult. Okay, well that's it for today, folks. Korean Lantern Mentorship. Have a great day, and I'll see you on the next video. Probably need to start doing some webinars. You know what I mean?